Hello, and welcome to the Dinar Daily, where we track developments related to Iraq's economy and its currency. Today, we are following a significant story that is gaining traction across international financial forums, a narrative that has been anticipated for years by many observers. Reports are emerging of what is being described as a pivotal moment, causing global tremors in financial circles. After a long period of speculation, hopeful waiting, and countless rumors, confidence is reportedly growing that the Central Bank of Iraq, the CBI, has officially activated new reference rates. This isn't just a whisper. It's being presented as a formal announcement, one that is sending distinct ripples across global banking and exchange networks, potentially signaling a new chapter. This development, as it is being reported, is not limited to the Iraqi dinar alone. In a move that is catching many by surprise, these new reference rates are also said to involve the Vietnamese dong. This alleged action is being framed as far more than a casual adjustment or a routine technical update. It is being interpreted as carrying significant weight, potentially signaling a much deeper shift in how both of these currencies will be positioned and treated within the complex framework of international markets. For those who have been closely monitoring this situation, clutching onto various threads of information and statements, the narrative itself appears to be evolving from pure speculation into the realm of institutional decision and execution. The gravity of this reported change is being underscored by its source, which is described as emerging from Baghdad, from within the walls of Iraq's highest financial authority. Sources cited in these reports suggest that careful planning and extensive technical preparation have been underway long before any public-facing announcement. The Central Bank of Iraq has reportedly completed the intricate, behind-the-scenes work necessary to recalibrate its exchange rate machinery. This effort is said to span both domestic financial systems and the international platforms that connect Iraq to the global economy, indicating a comprehensive approach to this multifaceted challenge. To understand the scope of this reported preparation, we must look beyond the simple idea of updating numbers on a rate sheet. The work described involves running complex compatibility tests on cross-border payment systems, a critical step for ensuring that international transactions can flow smoothly. It also reportedly includes aligning new rate data with the stringent protocols of SWIFT messaging, the backbone of international financial communication. Furthermore, it encompasses ensuring internal compliance with a web of banking regulations and, crucially, making sure that foreign reserves and currency swap facilities are adequately prepared for a potential sudden influx of upgraded financial flows. Observers tracking these developments suggest this was not a spur-of-the-moment decision, but rather a meticulously orchestrated project. This undertaking is said to have involved multiple departments within Iraq's financial apparatus, from monetary policy units analyzing the economic impact to overseas liaison offices coordinating with international partners. The overarching goal of this coordinated effort, according to this narrative, was to ensure that any new rates could be processed seamlessly across the entire chain of correspondent banking. In essence, Iraq appears to have prepared to present itself to the world with a newly calibrated exchange mechanism, aiming to position the dinar on a firmer footing. What makes this moment doubly striking, according to these reports, is the apparent synchrony with which a second nation, Vietnam, appears to be activating its own currency adjustments simultaneously. The Vietnamese dong, long held at a relatively stable but heavily managed rate against major world currencies, is now showing signs of newly emerging trading values. This information is reportedly surfacing from regional banking data emerging from financial hubs like Hanoi and Ho Chi Minh City. These signals, while described as cautious, suggest that Vietnamese authorities are likewise transitioning from a fixed or managed stance to one that is more responsive to market pressures. This parallel shift in Vietnam is contextualized by its economic performance. Vietnam's economy, long bolstered by booming exports, consistent trade surpluses, and a steady rise in foreign direct investment, is seen by many analysts as a natural candidate for such a move. By adjusting the dong in tandem with the dinar, the narrative suggests both nations may be signaling a broader ambition. This ambition is characterized as an assertion of greater financial sovereignty, an effort to reduce dependence on external pegging mechanisms, and a move to enable their currencies to better compete and settle in the global marketplace. Perhaps the most attention-grabbing confirmation cited in these reports comes from one of the United States' largest financial institutions, Chase Bank, in what is being described as a statement that has sent shockwaves through currency trading circles. Chase has reportedly acknowledged that its internal systems are being prepped for new international exchange operations. These new operations are said to be tied specifically to the dinar and the dong. The message, though carefully worded, is being interpreted as having a powerful subtext about the institution's operational readiness. The details of this preparation at a major U.S. bank are significant. Reports indicate that specialized foreign exchange trading desks are being configured to handle these currencies under new parameters. Internal compliance and settlement frameworks are being readied to absorb new rate flows, and risk management protocols are being updated. This updating is reportedly to handle what could become heightened volatility or significant shifts in liquidity. To practitioners in the financial world, the fact that a major bank is publicly signaling this level of readiness is being interpreted as a strong validation of the underlying changes. If a financial heavyweight like Chase believes it must actively position itself for incoming activity, the likelihood of real flows, transactions, and rate adjustments is considered far greater. For those who have followed the long-running narrative surrounding these currencies, seeing such a confirmation from a mainstream institutional player is viewed as more than symbolic. It is being pointed to as one of the first concrete institutional acknowledgments that this story is moving beyond the realm of rumor and theory, and is now edging firmly into the phase of technical execution. For many years, the notion of a significant change in the Iraqi dinar's status has existed in a nebulous zone, largely confined to speculative forums, wishful thinking, and a steady stream of anecdotal leaks. Now, with what is being described as a confluence of institutional moves, from Baghdad's alleged rate activation to Hanoi's emerging signals, and culminating in Chase Bank's public posture, the story is entering a new phase. This phase is one defined by tangible institutional infrastructure and the potential for real market action, a distinct shift from the abstract discussions of the past. Of course, these reports also highlight that many questions remain unanswered. How fast will this transition roll out across all platforms? How will liquidity be supported to ensure stable market conditions? Will foreign banks adopt the new rates quickly and uniformly? What pathways will exist for currency conversion across the vast network of correspondent banks? How will market speculators respond to these changes, and what regulatory safeguards will be put in place to manage the transition smoothly? These are critical uncertainties that observers are now watching closely to understand why this pivotal moment is reportedly happening now. One must look back across years of structural effort and incremental rebuilding within Iraq's financial system. First among the contributing factors is what one might call monetary stabilization. Over the past decade, Iraq has reportedly worked to gradually increase its foreign reserves, reduce uncontrolled fiscal spending, and press toward greater transparency in government accounting. The Central Bank of Iraq has taken steps to strengthen its balance sheet, manage liquidity more tightly, and bring its functions closer to international norms. Despite immense pressures beyond simple macroeconomic prudence, Iraq has also reportedly embarked on a sweeping digital banking overhaul. In recent years, the CBI and affiliated ministries have been working to upgrade payment rails, central clearing systems, and financial messaging infrastructure. This effort is aimed at aligning Iraq's systems with the expectations and protocols of international institutions like the International Monetary Fund, the World Bank, and the Bank for International Settlements. These technical upgrades are considered absolutely critical for any modern financial system to function globally. Changing a number on a rate sheet is trivial. Changing the plumbing behind the scenes is the real work. This plumbing includes bolstering real-time gross settlement (RTGS) systems, upgrading SWIFT connectivity, and ensuring that any new exchange regime can be deeply integrated within global banking networks. In this framing, what is reportedly happening now is less a simple repricing and more a complex systems launch. It's about turning on new, modern financial rails in a synchronized, secure, and robust way, allowing the country to interface with the world's financial system. Another crucial piece of the puzzle, according to these reports, is the effort to clamp down on parallel or black market currency activity. For years, Iraq has had a large, informal exchange sector operating outside of regulatory oversight, often with rates far different from the official ones. These parallel markets can weaken the legitimacy of a central bank's official rate, create economic distortions, and undermine public confidence. Many reform-minded officials in Iraq have long argued that curtailing this parallel market liquidity is essential for stability. If trading in the dinar is permitted virtually only through regulated channels, the official rate becomes more meaningful and not just symbolic. This requires stricter oversight, licensing of exchange houses, tighter enforcement against arbitrage, and better coordination with law enforcement to prevent illicit foreign exchange flows. As that parallel market volume shrinks, the central bank's rate gains greater traction and legitimacy. In sum, the new rate being discussed is presented as more than a mere number. It is a gesture of restoration and a reassertion of sovereignty. The parallel story in Vietnam, while different in its specifics, is described as no less strategic. Vietnam has, for decades, built an economic model centered on powerful export growth, deep integration into global supply chains, and favorable trade balances. Its industrial sector and manufacturing linkages have steadily strengthened its foreign exchange buffers. As trade surpluses accumulate and foreign direct investment flows in, the Vietnamese government gains more flexibility to consider currency adjustments, moving from a position of defense to one of strength. Over time, Vietnam has gradually loosened capital account restrictions, nudged the dong to adjust more responsively, and align more of its trade contracts to international market rates. Therefore, when we now hear reports of a dong adjustment, it is viewed less as a sudden shock and more as a recognition of an underlying reality. It suggests Vietnam has, through consistent economic growth, built the credibility to assert a stronger valuation, reflecting its rising economic weight on the global stage. The dual movement from both Iraq and Vietnam augments this broader narrative. The strategic timing of this activation is also noted as being unlikely to be a coincidence. In Iraq, major trade deals have reportedly been struck in energy, infrastructure, and technology. Some of these deals are said to be priced under new financial frameworks tied to the dinar. If true, that suggests the government may have been quietly using an updated rate internally long before this public-facing activation, testing flows and calibrating impacts. Likewise, Vietnam has been actively signing its own export and tech partnerships, further strengthening its bargaining position. In the wake of the Central Bank of Iraq's announced rate activation and the parallel movements in Vietnam, currency markets are reportedly starting to stir. Traders, speculators, and institutional desks alike report a sharp uptick in interest in both the Iraqi dinar and the Vietnamese dong. On social media and in private chat rooms, traders are posting about tracking order flow, pending position openings, and signs that liquidity providers are quietly repositioning themselves in anticipation of wider market movements. At the same time, publicly accessible forex platforms have not fully displayed the newly adjusted rates yet. Insiders, according to these reports, suggest this is intentional and part of a staged, controlled rollout. Many large systems and exchanges adopt such significant changes internally first. They test, reconcile, and validate the new data flows before exposing them to broad market participants. Thus, while the face value charts for the dinar and dong may still resemble prior levels today, the back-end engines and settlement systems are reportedly already calibrating. In the United States, a different set of developments is also emerging. Private holders of these currencies, some with modest portfolios and others with more significant stakes, say they are receiving communications from exchange houses or brokerage desks. These messages reportedly include requests for additional verification documents, notices of scheduled appointments, or preliminary steps to upgrade account status. These upgrades are described as necessary to handle newly activated rate flows, suggesting preparations are moving down the chain. Many see these notices as the downstream effects of the institutional preparations announced by larger banks. By signaling it is preparing its infrastructure and compliance capacity, a major bank may be precipitating the procedural cascades for smaller or individual holders. It seems likely that any exchanges, at least initially, will proceed in phases. Priority access may go to high-volume institutional players, with retail or individual clients entering in later waves once the systems are fully stress-tested and all regulatory clearances are definitively in place. A revaluation of this magnitude, as described, cannot proceed on promise alone. Behind every executed rate lies a complex web of regulatory scrutiny, legal compliance, and international oversight. Agencies, especially the U.S. Treasury Department and the Office of Foreign Assets Control, OFAC, are almost certainly watching closely. For a new currency regime to function globally, it must satisfy stringent anti-money laundering (AML) standards, ensure Know Your Customer (KYC) rules are enforced, and maintain sufficient audit trails and transparency at every single node. At its core, what is reportedly taking place now is more than just a shift in a currency's value. It is a reassertion of national sovereignty on financial turf. For Iraq, this moment is described as nothing short of historic. Emerging from decades of turbulence, sanctions, and instability, the move signifies that Iraq may be ready for re-entry into deeper layers of the global financial system. It is a way of signaling to the world that it can maintain, defend, and integrate its currency in a transparent, rule-based way that invites foreign capital, investment, and trade. Although official public displays of any new rates may still be limited today, reports insist that internal banking systems are already live with recalibrated values. Public availability will most likely follow a phased, controlled rollout, designed to maintain stability and guard against disruptive speculation. The Central Bank of Iraq, in particular, is likely to move cautiously, monitoring flows and liquidity conditions. Meanwhile, banking systems across the Middle East, Asia, and Europe are on high alert, preparing to adjust to what may be a new era in emerging market currencies.